In 1982, two hungry college friends in Ohio wanted authentic buffalo-style chicken wings, but they couldn't find a single restaurant in the entire state that served them. So they opened a tiny storefront restaurant near Ohio State University with a simple, wildly addictive formula. Crispy fried wings, cold draft beer, and wall-to-wall television screens playing live sports. That tiny storefront became Buffalo Wild Wings. Over the next 30 years, it expanded across every corner of the country, growing into an unstoppable billion-dollar casual dining empire with more than 1,200 locations nationwide. Yet, behind that massive national success lurked a dangerous corporate blind spot. To pack dining rooms on dead weeknights, Buffalo Wild Wings created a legendary discount promotion called Half-Price Wing Tuesdays. For millions of sports fans, college students, and budget diners, it became a weekly sacred ritual. Customers could walk in, order 20 crispy traditional chicken wings for roughly 25 cents each, drink cheap draft beer, and watch football for 4 straight hours. It was widely recognized as the single most successful customer traffic driver in modern restaurant history. Then, in 2017, the entire business model blew up. A sudden agricultural supply squeeze sent wholesale chicken wing prices skyrocketing to all-time historic highs. Almost overnight, Buffalo Wild Wings' most beloved promotion transformed into a financial suicide pact. The more wings the company sold on Tuesdays, the more millions of dollars it lost. Operating profits collapsed, stock prices crashed, an aggressive activist hedge fund launched a hostile boardroom coup, and a 35-year-old empire was forced into an emergency fire sale. This is the incredible story of the $400 million wing crisis, and how a 25-cent discount promotion nearly destroyed one of America's most iconic restaurant chains. To understand how Buffalo Wild Wings became so vulnerable to a single menu item, we have to look back at the origins of the chicken wing itself. For most of the 20th century, American poultry processors considered chicken wings to be low-value scrap meat. When industrial poultry plants butchered chickens, American families almost exclusively bought lean white breast meat. The wings, drumsticks, and necks were treated as cheap byproducts, often dumped into animal feed, exported overseas for pennies, or sold to budget soup companies. Everything changed in 1964 at the Anchor Bar in Buffalo, New York, when co-owner Teresa Bellissimo received an accidental bulk shipment of chicken wings instead of regular chicken parts. She refused to throw them away. She deep-fried the raw wings, tossed them in melted butter and cayenne pepper hot sauce, and served them with blue cheese dressing and celery sticks. The snack was an instant local sensation. In 1982, Jim Disbrow and Scott Lowry, two friends who had grown up in Buffalo and moved to Columbus, Ohio, craved those spicy, saucy hometown wings. Unable to find them anywhere in the Midwest, they decided to open their own neighborhood joint called Buffalo Wild Wings and Weck. In the 1980s and 1990s, the wholesale cost of raw chicken wings was virtually next to nothing. Processors were thrilled to get rid of wings, selling them wholesale for less than 25 to 40 cents per pound. Because the raw ingredients were practically free, Buffalo Wild Wings could buy thousands of pounds of wings for pennies and sell them at colossal gross profit margins. To fill empty tables on Tuesday nights, traditionally the slowest, deadest evening of the week in the casual dining industry, the founders launched Wing Tuesday. They offered traditional bone-in wings for as low as 20 to 25 cents per piece. The strategy was a masterpiece of restaurant psychology. Even at 25 cents, the company still made a small profit on the food itself. More importantly, customers never bought just wings. They walked in for the cheap wings, but they stayed for hours to watch televised sports games. While sitting in the booths, they ordered high-margin draft beer, soda, potato wedges, mozzarella sticks, and desserts. The promotion became a cultural juggernaut. On Tuesday nights, lines wrapped around the building at locations nationwide. Under the leadership of longtime CEO Sally Smith, Buffalo Wild Wings expanded aggressively across all 50 states. The company invested heavily in cutting-edge audiovisual technology, hanging dozens of giant high-definition screens in every restaurant and transforming the brand into the ultimate suburban sports sanctuary. Between 2003 and 2015, Buffalo Wild Wings was an absolute darling of Wall Street. Its stock price surged by over 1,000%. Institutional investors viewed the company as an unstoppable cash machine. Every new location generated millions in annual sales, and the company seemed completely immune to the economic downturns affecting other casual dining chains. Wall Street analysts praised the management team for their brilliant unit economics, while competitors scrambled to copy the high-energy sports bar format. Millions of loyal fans saw Buffalo Wild Wings not just as a restaurant, but as the default neighborhood clubhouse for Sunday football, March Madness basketball, and UFC fight nights. The company was opening dozens of new stores every quarter, signing multi-million-dollar sports league sponsorships, and minting record revenues year after year. Success seemed guaranteed for decades to come. But beneath that booming success lay a ticking financial time bomb. Buffalo Wild Wings was dangerously dependent on a single agricultural commodity: fresh, bone-in chicken wings. Unlike diversified chains like McDonald's, Applebee's, or Chipotle, which could easily balance fluctuating food costs across beef, pork, dairy, and grains, Buffalo Wild Wings bought millions of pounds of fresh wings every single week. And in the agricultural world, the basic anatomy of a chicken presents an inescapable mathematical reality. Every single chicken on Earth only has two wings. As the American appetite for hot wings exploded, fueled by Super Bowl parties, rival sports bar chains, pizza franchises, and fast food giants adding wings to their menus, the demand for wings skyrocketed far faster than poultry farmers could breed chickens. Poultry processors could not simply breed birds with 4 or 6 wings. If America wanted more wings, farmers had to hatch, feed, and slaughter millions of additional whole chickens. That flooded the commercial market with millions of pounds of excess white breast meat that consumers were not buying, driving down breast meat prices while sending wholesale wing prices into orbit. Consequently, the wholesale price of bone-in chicken wings decoupled completely from general poultry prices and became one of the most volatile food commodities in the entire global economy. For years, Buffalo Wild Wings managed to absorb these price fluctuations through sheer volume and growth. Whenever wholesale wing prices drifted upward, the company compensated by opening more stores, selling more premium draft beer, and relying on supplier rebates. Management repeatedly assured shareholders that wing price spikes were temporary seasonal blips that would always normalize after the Super Bowl. Because the stock price kept hitting new record highs, executive leadership saw no urgent reason to lock in long-term fixed-price supply contracts or fundamentally rethink their core promotional strategy. They believed their pricing power and passionate customer base made them invulnerable to agricultural shocks. That supreme corporate confidence would prove to be a fatal mistake. Then came 2017, the year the crisis erupted. A severe convergence of rising feed costs, booming global export demand, extreme summer heat waves, and structural supply chain constraints triggered an unprecedented spike in wholesale poultry markets. In 2017, the spot price for wholesale bone-in chicken wings surged to an all-time record high of over $2.20 per pound. For Buffalo Wild Wings, this was an unmitigated operational disaster. A single raw, bone-in chicken wing cost the company nearly 30 to 35 cents before it was seasoned, breaded, fried in hot oil, tossed in signature sauce, boxed, or carried to a table by a paid server. Yet on every single Tuesday, millions of price-sensitive customers flooded into 1,200 restaurants expecting their beloved 25-cent discount wings. The promotional math completely broke. Every single time a customer ordered a basket of 20 traditional wings on Tuesday, Buffalo Wild Wings literally lost money on the plate. To make matters significantly worse, customer dining habits had shifted dramatically in the post-recession era. Instead of ordering premium draft beers, cocktails, and expensive appetizer platters, thrifty college students and large family groups were ordering free tap water and stacking their tables with dozens of cheap Tuesday discount wings. Tables that used to generate $80 in high-margin dinner checks were now lingering for 3 hours and spending $15 on subsidized chicken wings. The iconic discount promotion that had built the company's empire had turned into an economic hemorrhage. Inside the corporate executive suites in Minneapolis, panic set in. In the second quarter of 2017, Buffalo Wild Wings reported a staggering 60% plunge in quarterly net earnings. Operating profit margins completely evaporated. The executive team faced an impossible operational dilemma. If they kept the traditional half-price promotion running, runaway wing inflation would bleed the company of its remaining cash reserves. But if they eliminated or modified the promotion, they risked alienating their most loyal, passionate customer base. In a desperate bid to stop the financial bleeding before the end of the fiscal year, management made a fateful, controversial decision. In late 2017, Buffalo Wild Wings officially killed the traditional half-price wing Tuesday promotion nationwide. In its place, they introduced a new buy one, get one free deal, strictly limited to boneless wings. From a purely financial perspective inside corporate accounting spreadsheets, management's logic was straightforward. Boneless wings are not actually wings at all. They are small pieces of compressed, breaded chicken breast meat. And in 2017, wholesale chicken breast meat was abundantly available and trading at near-historic lows. By forcing Tuesday promotional traffic toward boneless chicken breast, Buffalo Wild Wings believed it could protect its profit margins while keeping tables full. However, from the perspective of customer psychology and brand trust, the move was an absolute catastrophe. Wing purists, longtime regulars, and sports fans felt completely betrayed by the sudden policy change. Social media erupted with outrage and ridicule, with furious customers mocking boneless wings as glorified, overpriced children's chicken nuggets. Guest traffic on Tuesday nights plummeted by double digits almost overnight. Customers did not happily switch over to boneless breast meat. They simply stopped showing up to the restaurants altogether. With dining room traffic collapsing and earnings in freefall, the company's stock price tumbled by dozens of points. Seeing blood in the water, an aggressive activist hedge fund named Mercado Capital Management struck with full force. Mercado had accumulated an 8.6% activist stake in Buffalo Wild Wings and launched an intense, public proxy war against the board of directors. The hedge fund publicly published scathing presentations accusing longtime CEO Sally Smith and executive management of gross operational incompetence, failed commodity hedging, bloated corporate overhead, and disastrous capital allocation. Mercado demanded an immediate overhaul of the executive suite, the aggressive franchising of company-owned stores, and the complete monetization of corporate assets. The battle for control of the company turned bitter and personal, playing out across major financial television networks and business newspapers. At the explosive annual shareholder meeting in June 2017, Mercado won the institutional vote in a landslide victory. 3 of the activist hedge fund's dissident nominees were officially elected to the board of directors. Defeated and stripped of board support, CEO Sally Smith announced her immediate resignation after 21 years of leading the company from a regional chain to a national titan. The proud, independent restaurant empire was completely shattered and vulnerable. With executive leadership in complete disarray, operations bleeding cash, and activist investors demanding a fast exit, Buffalo Wild Wings was immediately put on the auction block. In November 2017, private equity-backed Roar Capital Group and Arby's Restaurant Group swooped in, agreeing to acquire Buffalo Wild Wings in an emergency buyout valued at $2.9 billion. The acquisition led directly to the creation of Inspire Brands, stripping Buffalo Wild Wings of its public listing on NASDAQ and permanently ending its 35-year run as an independent restaurant company. The $400 million wing crisis stands today as one of the most critical case studies in the modern food and beverage industry. It proved that traffic-driving discount promotions are a dangerous double-edged sword. When you train your customers to show up primarily for steep loss leader discounts, you do not build lasting brand loyalty. You merely build temporary price dependency. And when your core business model relies on a single volatile agricultural commodity that you cannot manufacture or control, A single supply chain shock can turn your greatest marketing triumph into an existential crisis. If Buffalo Wild Wings had aggressively hedged wholesale poultry contracts or diversified its menu pricing years earlier, could it have survived as an independent market giant today? Let us know your thoughts in the comments below. And don't forget to hit like, subscribe, and turn on the notification bell so you never miss another breakdown of the hidden rivalries, disastrous promotions, and legendary downfalls in business history.